Welcome. What a wonderful day. Thank you for coming. I just want to say that I'm a very average person with average IQ. You all are super smart people. What I'm going to talk about today is very simple things, and I'm hopefully we'll be able to connect more on those simple things, and we'll have fun in the process. Okay. So in the markets, there are a lot of ways to make money, many strategies. The thing that matters in the market is how much money you put, and the markets are the best form of getting feedback. When you put your money, the next day you can see how much you make, right? So I'm not here to give you any strategies or something. You could have your own standard wonderful strategies, and that's perfectly fine. At the end of the day, what you make through the action that you take is what matters. Everyone to read this story, please empty yourself. I'm pretty sure you all know a lot, but I want you to come with a empty glass mindset to this presentation. And I'm hoping that if you come with there's a wonderful quote. It says that you do what's already in your mind, and everything transpires accordingly, right? So I want all of you to just take a deep breath, take a 2 second deep breath, calm yourself, right, and then we can start. Okay. For folks who are joining, thank you for joining. Super excited. So there's a very wonderful quote that I always love. It's secret to happiness is low expectations. And as I said, right, I'm an average investor. I'm not super smart like you. I have average intelligence, I have average communication skills, as you would see my presentation skills as we talk through it. But hopefully you'll also have low expectations from me and help me in this process of helping you to understand the stock markets. So for the next 15 minutes, I would say I would encourage all of you to add a lot of questions in the questions link that has been provided. Let's keep it more interactive. And this is my first time in the public. I've never done like in the wild. I've done it within my community of 100 people where I do regular sessions with people, but this is my first time. So I really need your kindness and please wish me luck. I put in a lot of effort to create all the slides, and we are all learning. There might be some questions that I may not have answers to, and I'll get back to you. Or maybe you know better. I would love to learn from you, right? And all the subsequent material that you see in this talk or in this presentation is something not mine. I have copied from someone else, from a lot of wonderful investors. So yeah, I'm kind of a cloner, you can say. But I'm really grateful to all these wonderful investors who write a lot, who do podcasts, who do videos, who write all these wonderful books, and that's what has taught me. But what I'm going to share with you to the next lot of slides is the experience that I had in the last 10 years with the market, and I'm hoping that with that experience, with that special powers that you'll get today, you'll become a sleep well investor. So before we start the meeting, I want to make sure we set the right expectations. As I was saying, as I was alluding, right, low expectations means more happiness. So this talk assumes certain basic understanding of the stock market. So if you have at least 2 years experience, it will be very beneficial for you. This is for people who are scared of markets, who panic when the market dives, right? And or maybe it's you who have bought a very good stock sometime back, but it increased 200% or 100% and you sold it, and now the stock is going up and up, right? And you regret selling it, right? Or it's for people who have lost a lot of capital because of bad companies or bankrupt companies or bad management, right? This talk is not about giving you formulas. So yeah, if you came up with a mindset that you're gonna get some formulas here or some strategies, this is not the right talk, I would say. What my goal is to help you understand how to sleep well and invest, how to fish, how to develop a framework on how to look at stocks in the stock markets, right? You will get some genie powers here, but not formulas. Okay, I just want to say it loud and clear. So with that, I'm a co-founder of SECdiver.com, which is a US-based stock research platform that me and my wife co-founded. Whatever I learned through my journey of last 10 years is because of my spouse and my kids. My kids have asked me so many wonderful questions, so many basic questions that have helped me in this journey. So don't discount your kids. They are a really champion for you to understand, to call those common sense things that you miss typically. Other than that, I'm a software engineer by trade. I also host a lot of community sessions in my community. Snow Call Me. Again, we may talk about certain examples, certain stocks. Please do your due diligence before making investment. I am not an expert, as it. Do check with your financial advisor. And markets can be very dangerous. You can lose a lot of capital. So be careful. Everything that I'm going to talk about today is more for education and nothing else. Again, this is the same thing in a pictorial sense. Please be careful of markets. There's a good chance you can lose your capital. So let's start, right? So most of us are alluded to markets, right? Because we have seen people making fortunes in the stock market, right? Yeah. But the problem is, we all are scared of markets. And if you look at it, right, from a principal perspective, right, the reason we are scared of markets is not because it's mostly because we feel we're not in control, right? Has anyone experienced that, right? And do you know why we don't feel control? Feel free to type it in the chat box, so you can share why do you feel not in control of the market, right? We all agree, right? The problem we get scared is we don't feel in control, right? Like sometimes it goes 50% down, sometimes the stock drops unnecessarily, sometimes the stock pops up 25% based on earnings. Something magical happens. Sometimes without any reason, the stock goes up and down. It's very hard to figure out. And that's the idea. The idea behind this session is to help you regain control. And when you're in control, you're able to sleep well, you feel safe, and you feel good, right? And so my idea is to essentially make you business pickers versus stock pickers. Because when you chase stocks, you don't know what's going to happen. But when you chase a business, when you understand a business, you feel in control because you know what the business is doing. So there are, at a very high level, right, to become a sleep investor, you need 3 ingredients, right? The quant, which is the math part of it, right, which is very easy. It's very easy. If you spend some amount of time on it, you'll get it. But the 2 most other important ingredients are common sense and understanding your biases. I would say the third is the most critical part of it, because as I said, right, when you made a decision to buy a stock, right, you already made that decision in the mind. It's just a matter of execution then, right? You just say, I'm going to invest $10 in the stock, right? So it's all about knowing yourself, understanding your biases, right? And these things cannot be taught. Markets or cooking or anything, right? All this requires experience. You have to go through it. You cannot learn through books. You have to experience it, right? So I would say these are the 3 key ingredients that you have to master to get to do sleep well investing. And the first is very easy, right? So we're going to talk about all 3 during our next set of slides. So here's what we're going to cover today, right? We're going to cover all these topics today. So before we start, right, and everyone please answer this in the chat, right? What are your percentage CAGR return expectations? I hope everyone understands CAGR. So please use a percentage number and put it in the chat. Everyone able to hear me? I'm assuming, right? CAGR is cumulative annual growth rate. So it's like for every $100 how much you want to make every year. And this is like long term, like you're talking about the next 10 years. How much you want to make from markets every year. Perfect. Okay, so I want all of you to remember those numbers, right? Those expectations. As I was talking about low expectations, right? Like I want you to remember the CAGR returns. So in my starting talk, right, I just shared that I will not be sharing a formula with you, right? So today, but I'm gonna cheat a little bit. I'm gonna share a quick formula. And the reason is like all through my presentations, the most like everyone asks me the question. It's like the elephant in the room, right? Everyone asks me, oh, how can you value a stock? What is the price you should? How can you determine the right price for the stock? Right? Everyone will ask me this question, right? Is everyone able to see my screen? Okay, I'm assuming it's everyone will see my screen. So the formula is very simple. The value of a stock is basically 1 over R, which is return, which is what your return expectations are, multiplied by the profit of the company that you plan to buy, right? So the formula is like 1 over your return expectations. So let's say you are expecting 10% return for the market for a pretty good time, then it will be 10 times profits, right? 1 over 10%. If it's 8%, it will be 1 over 8%, right? So 12.5 times, right? So now a question for everyone, right? Please put this in the chat, right? If your return expectations are 5%, how much times profit you need to how much times profit will value the stock, right? Yeah, which is correct. Yes, yeah, it will be 20 times, right? Makes sense? Perfect. So I think I hope everyone got the math part, right? Which is what I said. That's pretty easy, right? And there's a second part to it, which is accounting, and that's the language of the business that will take some time for you to learn, right? So I have a lot of other courses that totally teach on those sites. We're not gonna talk about it, but now at least I'm hoping you got this formula, right? 1 over R multiplied by E, right? So now let's say you have 10% expectations, and there's a company which is making $1 billion of profit, right? So now can you guess what will be the valuation of the company? Again, please input that in the chat message. So what will be the enterprise valuation of this company that you're going to buy, which has profits of $1 billion and your return expectations are 10%, right? So it will be $10 billion, right? Makes sense? Why? It will be 1 over 10%, which is 10 times profit, right? So 10 times profit is $10 billion, right? And profits. So again, congratulations, you all got a superpower today, right? So what is the formula of valuation, right? It's simple, right? It's price of stock is basically your return expectations, inverse of return expectation multiplied by the profits. So as we talk further, I want to lay out certain strategies that you can use to make a good amount of returns in the market. So if you're looking for more than like close to 8% to 9% return, then we all know, right? Passive indexing is the best way, right? So there are various kinds of funds on the right side that you can leverage. I think the most important thing here is to go for funds which are low fees. I think that's what will help you compound for the long term. If you think you want more, then the second best strategy would be to buy a Berkshire or Markel stock. Markel is run by Thomas Gaynor, or there are other set of funds that I've listed on the right side that you can check out. So these funds have beaten the market for more than 15 plus years. So Buffett is God, right? Everyone knows Berkshire, right? So that's another strategy. What I'm looking for is a basket of buying wonderful companies, and that can give me a return of 10 to 20%, and that's what I'm trying. And you will see, right? As we talk further, right? This 3 to 4% difference in the CAGR is going to be a massive generator of money for you. We'll talk about that, but this requires a little bit of work, right? And that's what we're going to talk about today, right? The fourth strategy is like following the crowd, macro timings, shorting, technical indicators, gambling, futures, right? So on. So yes, you can make a lot of money in this in a very short time. It's not for me. It's very stressful. You cannot sleep. There's a lot of work that needs to be done. You need to time the market, and it's not something that I can do because I have a day job to manage, right? And it's just harder, right? Given the commitments that a person like me have to have with my family, right? So for me, this is not the part. For some people, it could be, right? So here, everyone has seen this graph, right? Like this graph is showing that in stock markets have beaten all other asset classes over the time. If you look at the last 50 years, right? $1 invested in the stock market would be $74 today, right? Isn't that amazing? Versus like real estate will be $11,000 or checking accounts, right? So that's the power of stock markets, right? So at 9%, like at 9% growth rate, the index is making every $1 as 74 times, right? So $1,000 became $74,000, right? But now let me tell you, like if you buy the study that I was trying to say, right? But if you buy quality stocks which give you 12% return, that 3% alpha gives you 214 times difference, right? So you make 289 times your initial amount versus 74 times the market, and that's what I'm trying to go towards, right? Does that make sense to everyone? So now I have a question for everyone, right? Imagine you are able to get 15% compounded. Can you guess what would be that number be? What would be that $1 be in the next 50 years? Just at 15% compounding. Again, please put in the chat. 100 million VG Singh says. Yeah, again, like we're talking about what $1 will become, right? Then if you put in $1 million, you need to multiply by that number, right? So again, the starting capital, let's assume is $1 for now, right? I think the number is, it will be like 1,000 times. Like the math is very simple, right? So I don't know if you know the rule of 72. So 72 divided by the percentage return is the number of years it will take for you to double. So if you expecting 15%, 72 divided by 15 is like 5. So every 5 years will double, right? And that's how you get that number. Again, the next cohort that I'm not, by the way, I'm an engineer. I'm a straight shooter. I'm not a sales person, but I'm conducting this course, and feel free to sign up. If you join the next 2 days, you get 25% off. So email me if you feel you are getting some value here. So let's go back to the basics, right? What is a stock, right? Everyone thinks like stock is everyone keeps trading a stock. They think it's a piece of paper that they can keep gambling or speculating. It's not. Stock is not that. Stock is actually a partial or full ownership of business. I think we need to soak this principle in, right? That it's like similar to how you own a home or a farmland, right? And the problem is what we do is we keep trading the stocks and we just don't realize the full potential of the stock. It's an investment for the future returns. It's a bet on American capitalism or wherever you stay. It's a bet on human potential. What human potential can do, right? And we have seen that, right? We have seen the last 50 years, right, of indexes, right? $1 became 74 times, right? So So that's not the stock. When I was looking at markets, right, sometimes I used to get, oh, I made 20%, let me get on the market, right? And then I'm trying to think of, okay, should I buy the stock? But now it increased further, right? So like I'm anchored on that. So I would never enter the market. So it happens to a lot of us, right? So I would say the mental model that you need to have today is like a stock means there's a business behind it, and it's a partial or full ownership of business, right? That's what I look at. So let me ask you another question, right? So if you're buying a stock, what's your process to buy a stock, right? And again, please feel to type in the chat. So I think not sure of any of you, but I know some of my friends in my community as well as during my past life, right? I used to buy a stock because it's cheap, right? It's just some dollars, right? It's gonna go 10x. I'm gonna make 10x money, or it could be some tips that I got from some friends or someone, right? And we go by all these things, right? But we never look at the underlying business, what the underlying business is doing, right? We go by hype, we go by the momentum, or we say, oh, this stock has dropped 50%. How much is gonna fall, right? And we just end up buying it, right? We want to make our money double. That's our goal. Simple, right? Now let me ask you, right? If you have these three stocks, stock A, stock B, stock C, selling at this price, which one do you buy? Again, please put your comments in the chat. Vipsinji, yeah. Again, I think we need more interactivity, so I would appreciate if everyone can I think the answer here is it depends. You would not buy anything. It depends. And yes, you're correct. It's a Berkshire stock, and you have to look at a lot of factors before buying stock. And what happens is a lot of people, they just look at the price and then buy it, right? That's not the right way to look at. Given this is one of our things, I'm compressing it a lot, but in the class that I'll take, we're going to talk about that a lot. Okay? So now, what are the most important things to know before investing stocks, right? I think like when I was starting my journey, it was like, okay, I want to make money. That makes sense, right? But as investors, we need to ask this question every single time. What am I looking for before investing in stocks, right? And for most of the people, right, they are looking just for returns, but that's not the right way to look at it, right? What you should look at is like, what is the risk of losing money? That's the number one thing you should look at, right? The second thing you should look at it, will it compound my wealth for the long term? By long term here, it means like more than 5 years, more than 10 years. Can it compound? Like if you're looking for just making like a quick buck, like 5% return, 10%, that's not, you are not investing. Investing doesn't mean that. Investing means long term. That's the definition of investing. And remember, it's a transaction. When you are buying or when you're selling, there's another person on the other side who's also doing the opposite of you, right? So, and one of you will be correct, right? One of you has, both of you have the same information, right? So one of you needs to be correct, right? If you are correct, you need to do a due diligence. And the number one question that you need to ask before buying or selling is why the other person is doing the transaction. And if you are able to reason why the other person is doing it, it's going to make you a very good investor. Trust me. And that's the thing that we all miss. So I think the most important thing I would say that you should focus on is like, will I lose my money in the stock? Why the other person is selling it, right? So as I said, our key job as investors is not to lose money. And we're going to talk about it, right? So now the question for all of you again, please try to pick an option. What do you think we control in the stock markets? Again, please feel free to type in. And if someone wants to speak up, that's perfectly fine. Yeah, I think like the thing is, the only thing we control is we don't control returns. We control our behavior. We control our time. We control what price we pay. We control the process that we use to buy or sell that stock, and we control how much risk we are taking it, right? Let's say we have $100,000. Should I put $10,000? Should I put $5,000? Should I put $100 in the stock? I don't know, right? That's something you control. And I think the problem is if we know what we control, we're going to become sleep investors, and that's what we're going to talk about today. So the challenge is like, especially in the US market, right? There are 10,000 companies, right? And there are a lot of companies in the world, right? And the problem is we need to find companies to invest, right? So and we have less time. We have families. So how do you make that decision to buy and sell in a minute, right? That's the idea, right? Life is too short, right? We need to be able to make that quick decision. And once we are comfortable with the stock, then we want to spend more time with it, right? So how do you filter the stocks to find that perfect stocks for you to invest, right? So that's what we're going to talk about, right? So let's go back a little bit basics, right? So let me ask you a question, right? And again, please feel to share, like speak up, right? If you want, unmute yourself to speak up, right? When you are giving money, like do you agree? All of us agree that buying a stock is like giving a stranger your money. Is that fair? Can anyone say yes, no? What do you think?
Yeah, I suppose so.
Yeah, is that correct? That makes sense to me. So when you are giving strangers your money, right? What do you look for? I'm assuming most of you have bought their homes, right? They are taken a loan, right? Or they bought some goods and services, right? What do you look for before giving people money? Again, feel free to chat, type if you're shy, but you can speak up. That's perfectly fine. And like if you're giving someone $100 and if you're giving someone $10,000, right? You think a lot, right? Fair, right? And if you're giving someone for like money for a good amount of time, you also think more, right? Is that correct? But what, like if you look at like, so this is what like we do, right? Like banks, right? We do deep research. We spend a good amount of time, right? We try to look at the, like, can we trust the person? Can we trust the service? Does he have high integrity, right? We look at the historical records, right? Is that fair? We look at the character, right? And if you're in doubt, we just avoid. Is that correct? Does all of us agree? Come on, I want all of us to say something.
I agree with that. I generally avoid doing loans whenever possible. I don't like paying interest, so every chance I can, I avoid that.
So in this case, you are giving loan to someone, not the reverse.
I see. Yeah.
So it's like when you're giving loan to someone, right? You're giving money to a stranger. Is that correct? So if you go back to the basics, right? Even in stock markets, what we are doing is we are giving our equity, we are giving some capital to the company to invest, right? And we check when we're giving money to strangers, we look for some of these things, right? Is that fair? So there's a wonderful story in 1907. There was a big panic. JP Morgan Chase, it's a wonderful bank right now, but JP Morgan Chase, the founder of Chase Bank, he was called in a congressional hearing and he was asked, sir, what do you do before giving people loans? What do you look for? And you'll be surprised what Chase told, right? He said, sir, we give money based on character. We look at the character. We all want quality, right? We look for quality living, we look for quality education, right? We look for quality life. Is that correct? Right? And we spend a good amount of time finding quality. Is that correct? Right? And do you know why we like quality? Because quality is stress-free, right? We know this works, right? We know the Dyson vacuum works, right? We know it's a really good quality product, right? We know we can buy from Costco or Amazon and we can return it if we don't like it, right? Correct? Right? Because we know we have a record of working with a company, right? We give it to our wonderful friends, right? Because we know that they will give us money back, right? Is that correct? Everyone agrees?
Yeah.
Let me ask you a quick question, right? Do we follow any of this while investing in the stock market? Do we look at the historical records? Do we look, is the management competent? Do they have integrity? Do we look at, do they have skin in the game? Do we look at that they have a good amount of debt, or can they pay back the money?
Definitely, yeah.
We don't, right? And so I would say when we should think, when we are giving money to the stock market, we should think, the mental model that we should think is like we're giving someone a loan. We should look at the management, We should look whether it's trustworthy. We should look at historical records. Do they have profitability records? Do they have zero debt? Does the management has experience in that field that they are operating it, right? Does the business have high returns on capital, right? Do they have skin in the game? Are they aligned, right? And the most important thing we understand is why the stock is selling, why the stock is being sold for so cheap, or for whatever reason you're interested in buying the stock. Why is it happening? Is there some uncertainty in the business, or is it just short term? Right? Are there some clouds that are covering the business right now, and that's why the stock is dropping, or what's the reason? Why is the stock growing so much, right? What's the reason, right? And so all this information is available in these three facts I call it: the income, the financial statements. In US they're called 10K and 10Qs, is the annual statements and quarterly statements. There's something called proxy statements, and all of these conference calls and transcripts provide you all this data for you to check. The problem is none of us have opened those documents to validate all this information. We just look at some portals and we look at some tips and we just end up buying. Is that fair? And so I would say the number one takeaway that I want all of you to take away today is become a bank loan officer, right? Can we all say we'll all become bank loan officers? So the next thing we're gonna these are the next thing we're gonna cover. So before we all agree, right? So there's this $100 bill, right? Whenever we see this $100 bill, right, we know the value of that $100 bill is $100, right? Fair? We can go and give it to someone and get $100 value of services for that, right? Fair? So let me ask you a question. Like, let's say you see this $100 bill on the road. Did the value change? No, right? What if you see this $100 bill on the road, but it's inside a purse? Only you know about it, right? Did the value change? No, right? What if someone throws this $100 bill in a trash can, right? And it's in a good condition, but did the value change? No, right? Is that correct? So what do you think is the fair value of this dollar bill? It's $100, right? We all agree, right? So let's say tomorrow a stranger who doesn't know the value of this dollar bill, right, and he comes to the market and he wants to sell this dollar bill, right, and he starts with the initial bid of $50, right, and all of you are looking at it, right? You know the real value is $100, right? What would you buy it for? Again, please put it in the chat. Thank you, Vipsingji. Right, $51. Wow. What else? You're a wonderful investor. I love you. How much you should pay for this $100 bill, right? Remember, all of you are looking at this, right? So all of you are rational investors, right? And this stranger who doesn't know about the $100 bill, right? So maybe when he enters the market, only one or two of you know about it. So you say, oh, he's selling $50, let me buy it, right? Let me try to buy a lot. So he'll sell you 10. And as many people start seeing it, right, the price of that dollar bill will start auctioning, right? People will start bidding for it. Okay, I'll pay you 70. I'll pay you 80. I'll pay you 90. And with time, the $100 bill will reach $100 value. Is that correct? It wouldn't go for 90. It wouldn't go for more or less. Right? It will reach its value. And that's what happens in market. In markets, the price of an item or a good or a service reaches its final potential after everyone knows about it. Bargains are gone. Correct? Right? So as investors, but remember, as investors, our goal is to pay less for the investment. So we need to know when the bargains are available and go get it. Okay? So as I said, our goal as investors is to buy the $100 bill for $100, right? And in this case, we all know the $100 bill, right? So now let me ask you a question. Now tomorrow, someone again another stranger comes to the market and says, I'm going to send this $100 bill for $110. Will you buy it? Again, feel free to speak up. No, right? What about $115, $200, right? No, right? But that happens in the market, right? Right now, there's some companies who are being sold for $200. Some companies are being sold for $100. Nvidia, Meta, right? That's being sold for $150, $200, right? But we are buying it, right? A lot of people are buying it, right? That's what happens in the market. Markets can go anywhere, right? There was 2 years back, Meta, Amazon, Google. I'm just using this example because everyone knows about them. They were at 50% lows. Meta was like at $90, right? And so we were getting those $100 bills for $50, but we could not buy it. But we didn't have the courage to buy, right? Fair to say? So we should never buy it, right? Do you agree? All of us? Yeah. So I think what's our key job? Our key job is to buy at a price less than the value. That's what we call investors. And the principle for that is called margin of safety, right? I hope everyone will use this principle going forward, right? So let's talk about the takeaways, right? So we should think like a owner, right? We should not talk about gambling. We should not get into gambling and speculation. We should avoid losing money, right? And we always want to buy with margin of safety. So I want all of you to repeat with me, right? From today onwards, I will think like a business owner. I'm not hearing anything. Come on, let's repeat with me. I want to think like a business owner. I think everyone's shy. Okay, thank you. So the next thing, so the second learning that I want to call out is like we all want to become bargain hunters, right? As we saw, right, that $100 bill that when initially a stranger came in, right, we wanted to buy it for whatever was saying, $50, right? He didn't know the value, right? So we are buying it. So we want to be bargain hunters, right? We want to value the business first. We want to understand its value, and then we want to pay a price less than the value, right? When I was in California, right, there used to be this DG dealership, and they used to have this hoardings all across California, at least in Bay Area, and to say we are selling our cars. These are no-brainer deals, right? And so I want all of you to understand when a no-brainer deal like Meta selling at $90 or Amazon going at $80, Google going at $80, when all these are flashing in the market, I want you to be biased, right? I don't want you to wait for those. I want you to be biased, right? So recap it now, right? We want to become a bank loan officer. B, we want to become bargain hunters. Fair? Are we good?
Yeah.
Welcome aboard, right? So I hope you all are having fun, right? Can I get a thumbs up? Can I get a reaction? If everyone's enjoying the presentation, can I know, is this being helpful until now?
It's helpful. I don't know the math side as well. This is what I'm learning a lot from.
We're going to talk about it. So I will definitely, let's keep adding your questions. We're going to talk to the end of the presentation about the math part of it. But I hope you got the first formula, right? How to calculate the stock, right? It's 1 over return expectations. Fair?
Yeah, I took screenshots and everything.
Perfect. So I'm not going to spend a lot of time on this because we are running short, but business can be thought of as like buying a movie ticket and going to a movie theater, right? So there are limited amount of tickets. And what happens if it's a hit movie, right? People will buy the movie tickets in like, in black market, right? So they'll up the price for it, right? And what if the movie is not bad? No one will buy, right? The tickets will go for cheap. So that's what happens exactly in the market. There are times when so if you look like the business as a movie, that's going to unfold, right? And it's going to take like 10 years for the movie to unfold, right? It's like buying a movie to a movie, like buying a ticket to a movie, which can be a hit movie, which can be a super hit movie, it can be a flop movie, or it can be a super flop movie, right? So there are all this range of possible spectrum that you can range into, right? What do you think? Do you think you have opportunity in the market? What does all think? Right? Yeah. So sometime back I was reading this Buffett quote where Buffett says, right, that you can make 50%. If I have less amount of money, it's like closer to like less than $10 million, I can make 50% every year. And I was always wondering, how could Buffett do it, right? Like, how can he guarantee all this, right? But like, I was always wondering about it. And then something struck to me. I'm gonna hopefully share with all of you, right? So here's a table, right? If you look at, these are the top 10 companies in the US market. And if you look at the highlighted row column, right, which is like the 52-week low, 52-week high difference, right? You'll see companies are being sold for, you know, their low prices and the high prices, right? And if you, I don't know if you read literature, right? There's something called efficient market hypothesis. The efficient market hypothesis says that every stock at any point of time, because all the information available to public, is selling at its true value. So if that is true, then we should not have such disparity, right? Is that correct? So like there's a good chance if you are able to calculate the price of Amazon for $118, and if the price goes near it, right, you should be able to, you should be a buyer, right? And today you would have made like, you know, 61% on Amazon, right? Or for same for Nvidia, right? Or even for Tesla, right? You would have made that much money, right? So what we can learn is like Mr. Market can sometimes be crazy, right? It can give you those opportunities to buy the companies, right? The only thing is you need to have the guts, you need to have the conviction to pull the trigger and buy, right? You need a little bit of continuous thinking, right? Here are some recent examples that happened like in like last 6 months back. Cigna fell down, Markel fell down a lot. Right now, Paycom is a stock that fell down to its lowest level for the last 5 years. CRM, which sales was fell down 20% on earnings, right? So markets gives opportunities. The only thing is you need to figure out what is the value of the stock and what's the price the market is paying. And if you see the difference, you want to, you know, load the gun. But what we do, right? When the stock falls, we get scared, right? We saying this is not the right time to invest. We just want to wait, right? That's what we do. Is that correct? So again, the takeaway that I want to call out is there are always opportunities. It just depends on how you calculate the value of the stock, right? And that's what will help you, right? So you need to have an estimate of the value of stock, right? So this is a fun fact. I hope everyone has negotiated, right? Stock market is the only place where you don't need to haggle to get the deals. It's the only place I feel where you don't need to have bad mouth. You don't need to argue with anyone. You can get discounts at some time. We also have been told, right? High returns mean high risk, right? We all have been taught that, right? Into literature, right? Is that correct? But it actually doesn't mean high return doesn't mean high risk a good amount of times. And I'll give you some examples as we talk about the greatest investors or the good investors. They always look for scenarios where they can get high returns but with low risk, and that's what we need to look for. So when you look at the 52-week high and 52-week low, right? There was a pretty good time for us to make those situations, right? We had that time where the market was low, but we could have bought it, right? But we didn't do it, right? So that's what great investors look for. And here are some examples. If you look at their biographies, or if you look at some of the acquisitions, you'll see what they look for. What is their mindset? Especially, definitely read the Richard Branson Virgin story, how he started the airline. It's wonderful. So here are some example stocks that are right now at 52-week low. Again, this is not not a recommendation to buy. You need to do your due diligence. You need to find the right value of it, and then you can see how far it is. What is your margin of safety on the price of the stock, right? And remember, if you cannot decide, the answer is always no. Just remember that, okay? And so we all agree, right, that there are a lot of opportunities. Every time there are opportunities, and the only thing that we have to figure out is like, can we find scenarios where we have high returns with low risk, right? And the beauty of a wonderful investor or a great investor is like he's able to reject 90% of the ideas. That's the beauty. And so we need to become rejection machines, right? Like how the banks determine should they give you loan or not. We need to be good at that. But the problem is we don't do that. We just want to jump onto every opportunity we get. We just want to keep investing. Oh, someone said something, let's invest. We don't think. We don't do the research that needs to be done. So let's talk about how much price we should pay for a stock, right? And I think this is the elephant in the room that everyone asks me, right? Okay, Chandan, you told me everything, right? How do I figure out the price? What is the multiple I should pay for the stock, right? So let's talk about how should we value a business, right? So I'm hoping from now onwards, no one will talk about stock, right? They'll talk about business. Is that correct? Perfect. So let's before we go into valuing a business, let's go into a normal life, right? Does any one of you here like bargains?
Always.
Always, right? Have you what do you do to find bargains? Can you share some examples, please?
What do I do to find bargain? For me, I usually go for when something's been hit twice. Like a good example would be Boeing tragically had those crashes in 2019 or whatever it was that drove it down, and then followed by COVID that did this 1-2 punch where their stock went from 400 to 100, and they're too big to fail. So I jumped in at that 100.
Wow, I like it. I think in this case, I'm not talking about stock markets. I'm talking about normal lives. Like, have you ever bought like, you know, gone to grocery store and bought something at a discount? Like, oh, today's a wonderful deal to buy all this grapes, or today's a wonderful deal to buy all this iPhones, or today's a wonderful place, right? Have you looked for bargains or cruises or travel deals?
I see. No, not as much, honestly.
So I think like I'm not sure about like a lot of you, but I have always looked for bargains. So people who look for bargains can become good investors, right? And so what we do is like when the reason we look for bargains is we are looking for a deal, right? We want to make some person. We know that this item is typically sold for $100, but today we are getting for $30. So it's a wonderful deal. So let's buy, right? Is that correct? And what we do, right? We go to some of our favorite sites, right? We go to Amazon, we go to eBay, we figure out the worth, right? We know how to compare, right? We need to figure out the right price, right? And then we go for bargain hunting, right? We wait for Black Friday, right? Is that correct?
Yeah,
right? We put a lot of time, right? We do a lot of research. We read a lot of research reports. We talk to our friends. We tell our spouses that, hey, can we wait next 3 months? Black Friday is coming. We'll buy it then. Isn't that true? But you know what? Do we do the same thing in the markets? We don't wait. We just rush to buy the stock. We say this stock has fallen more, so let me do dollar cost averaging. I'm going to buy more without understanding what the value of the stock is. We sometimes overpay for the stocks, right? We ask how much lower can it go, right? We just say, oh, it's already fallen 50%, right? Let me buy it. We don't do any due diligence. The research report that we spend when we buying, like I remember when me and my wife bought a Dyson like a long time back, it was like $2-3. We thought a lot. We give it like 1 month of thought to buy it, and that's what we need to do, right? We need to employ the same bargain hunting, the same methodology of finding deals in the stock markets too, right? We need to wait. We need to have patience, right? And the biggest problem that I feel that we don't have a mechanism to compare stocks. We don't have we know. Let's say this item is selling for $20 in a store, right? We'll go to Amazon, we'll do a price comparison, we'll check it. So we don't have like comparison tools that can help us figure that out, right? But we all agree, right? We have those bargain hunting genes. Is that fair to say? We also have the patience. So again, let's become bargain hunters in the stock market too. That's what I would pass as a takeaway. We should always reject ideas. We should always try to wait. We should have high hiring bar. With that, let's go shopping. Okay. And so do we know when we can get bargains in the stock market? Like during product cycle, right? We know we get bargains during Cyber Monday, Black Friday, or Amazon Prime Day nowadays, right? Do you know when do we get on liquidation when a store is getting liquidation, right? Do you know when we get bargains in stock markets? Anyone wants to chime in?
Earnings.
Oh yeah, pretty good. Yeah. What else? Something
Major,
like.
Was that Pavan?
yeah, I'm saying major financial announcements.
Yes, yeah, I like that. Thank you, Pawanji.
Oh yeah, whenever there's a holiday or something, some sort of big sale day.
Yeah, so exactly. That's what we need to do in the stock market. We need to wait for those wonderful opportunities, right? We need to have the patience. So I'm not going to spend a good amount of time, but I've built something called as a compare feature where you can compare stocks, and so you can figure out the right value, and then you can go and buy it. We're going to talk about it later more. So again, just to recap, right? You want to act like a bank loan officer. I just want to call it the superpowers that you already have, right? Which you're not utilizing in the stock market. So you are already a bank loan officer. You know whom to give money. You are bargain hunters. You have a checklist, right? When you go shopping, you check all these attributes needs to match. All these quality attributes needs to be there before I buy home, right? Or before I buy a particular product. But we all fail to apply in the stock market. So I want all of you to remember your superpowers and learn to say no to a lot of ideas. Okay. So let's understand what does a stock price reflect. Essentially, a stock price is a reflection of three things. It's the value of the stock, which we just talked about. It's the future growth and the expectations. And expectations and future growth drive a lot of things in the market, right? And that's why some stocks are overvalued, some stocks are undervalued, depending on the thing. And that's what we need to look for when you're looking as investors. Okay? So I'm going to help you with the first two parts, which is value of stock and future growth, hopefully. And then expectation is something I would say have low expectation, right? That's what I've been telling every time. So let's talk about this, right? So how should we look at stocks, right? The essential framework that I would say is we should look at as in terms of opportunity cost. So like when we were looking to buy like a Dyson or iPhone, what we did was we went to Apple stock, we went to Apple site, we saw the iPhone was $1,000, and then we saw Costco offering it for $500, right? So we will say, oh, if I buy from the Apple store, I get the iPhone for $1,000, but if I buy from Costco, because I have Costco membership, I can get it for $600, right? So you look at the opportunity you buy, right? Is that correct? So likewise, we need to look at the opportunity cost in the stock market. And so let's go back to basics again, right? So let's say you have a good amount of money and you want to go to a bank, right? And you want to give them the money, right? What do you look for before putting money in the bank, right? You look for the interest or the yield, right? Or the match and how much time you need to put the money in the bank. Is that correct? Right? And so,
yeah.
Right? And so sometime back, like banks are offering pennies, right? They were offering like less than 1% of interest rate, right? But right now the risk rate is 4%, right? So our goal as investors is to make more than the bank. Is that correct? So we want to make an interest rate that's higher than the bank. So that's the opportunity cost that we're talking about right now, right? A lot of people right now are comfortable giving their money to bank. Is that correct? They're happy to give their money for 5% interest rate. Is that correct? So now let me ask you, right? Which bank will you deposit your money? There's a bank which is giving 5% interest rate right now, bank A, and there's a bank B which is giving less than 1%. Which bank will you go for? I think the answer should be obvious, right? Fair? Bank A, right? Everyone agrees? So another way to look at this is like, so you see, we all are happy to give our money to banks because we feel we are in control. We feel we will not lose our money. We feel our capital is safe, right? And hence we can sleep well, right? Is that correct? But if you look at it from a perspective of returns, right? Like how much time will it take for us to get our money back? Like let's say we give bank $100, right? Every year on that 5% bank is going to give $5, correct? How much time will it take for us to get our money back? Like, right? That's the thinking that we need to have in the stock markets too. So now let's say we are getting 10% yield from stock from the bank, right? And we invested $100, right? So we're going to get $10 per year. Is that correct? So how many years will it take for us to get $100 back and the principal back? Can anyone put a message on the chat, or they can speak also if they want? 7 years. Yeah, I think let's keep it simple. I really like the answer. 7 is the right thing actually if you look at compounding from a compounding perspective. But like if you keep it simple, right? It's 10 years, right? Fair to say, math, 10 every year, right? Correct. So that means from the bank we're gonna get our money back in 10 years, right? So now if I tell you there's a stock which is giving you 10% yield, and then there's a bank which is giving 5% yield, which is a better investment? Let's assume that the stock is risk free, is backed by a wonderful company. You're not going to lose money. Do all of us agree we'll give our money to the stock? Is that fair to say? Can we say that? Because we're just comparing on one axis, right? How much yield we're gonna get? Is that correct? The math makes sense to everyone? Okay, cool. So with that said, right? So let's do some math, right? Again, if the yield from any company is 5%, how many years you need to wait to get your money back? 14 years. Thank you. What if the yield is 1%? How much will it be? So the answer is like, if you, again, we're talking about simple interest right now. I'm not talking about compounding because that adds a little bit of complexity for calculation. But if you're getting a 5% yield, you need to wait 20 years to get your money back. $5, 20 times will get you $100 back. Is that correct? So essentially what we're doing is we're giving bank $100 right now to get our full money back after 20 years. Fair? And sometime back we were giving banks at 1% interest and we were waiting 100 years to get our money back. And that's what happened in the banking crisis, where banks were giving people loan with very low interest rates, right? And that's why the bank fiasco happened. The Silicon Valley Bank lost its status, right? Correct? So our goal as investors is to reduce the time to get our money back. Just remember that, right? That's how we should look at it. So if we can do the same way for stocks, if we can figure out the yield from the stock, then we can calculate how much years we have to wait for us to get our money back. And if you can do that for good companies, you'll be able to get your money back. You will have the courage. You're going to get your money back, right? Because they are generating that many profit. Right? So now let me ask you another question. So let's say you have a business in your local town which you own, right? You own that business and you are generating $1 million of profits. How much would you? And let's say Peter G is owning that business, right? He owns that business. How much would you sell it for? How much would you sell it for? How much would you buy it for, BG, from Peter?
So there's some different. Yeah, it depends on that. We're looking for a long time. Yeah, I'd say at least 20 million.
Yeah, I really like the answer. First of all, I think the initial answer like depends, right? That's a very important. Right? There's so many things I didn't tell, right? So let's assume that this $1 million is going to come for at least 10 years. Like, we have struck a record for the business, and Peter G is a very nice friend of yours, right? So you're saying 20 times, right? 20 times, is that correct? 20 times. Peter G, will you be able to sell? Would you sell your business to BG if he's ready to buy it for $20 million? I think I'm assuming the answer is yes, right? Okay. What about $30 million?
Are you asking me?
Yes, I was asking you. Like,
oh, sorry.
Would you be ready to sell your business for $20 million to BG?
Yes, absolutely.
What about $10 million? Let's say Chandan comes and tells, I'm going to buy your business for $10 million. Will you sell it?
Yeah, I'd sell it for 2 to 3x.
Okay. So I think BG, would you, let's say you're in the business, would you sell it for $2 million?
Depends on the business.
No, let's assume it's a wonderful business. You don't want to sell it.
It's a wonderful business. I don't want to sell it. No, I would go for 2 million.
Right? What would you go for?
I would probably go for 10 to 20, and then higher than that if I can.
Correct. So as we also, right, we are able to figure out the value of a business, right? If you know the profits of business for the last 10 years, right, we are able to calculate the range of the prices. Is that correct? So it could be anything between 2 and 20. Is that correct?
That's fair.
Right? Is that correct? So now let's say Chandan is a third person. No one knows about it. You don't know any of him. I've provided all my historical records to you. My financial financial statements and I'm earning $1 million profit every year, right? None of you know me. What would you buy it for? How much would you buy it for? Again, all of you can type chat at least 10 million. Okay, wonderful. Sushanji says 3 million. What about Bibji? What about you?
Probably go for 20 million. I'd say if you're getting 10 years at 1 million per year, then
No, I'm a stranger. You don't know me. In the earlier case, you knew the other person. He was your friend or whatever. Right? You're buying from him, so you can trust him. I'm only giving you the records. Yeah, that's it. It's audited, obviously, by lawyer, by auditor.
yeah, still, I mean, I'd still go for around the same if it's legitimate financial statements that have been audited for 1 million a year for 10 years. Yeah, that seems fair.
I think you are a pretty good investor, I would say. So I think again we saw, right? We are able, when it's someone else's business, we are able to get a range of values, correct? Like it ranges from again 3 to 20 million, correct? Is that correct? Right? And now I think what you see is like we are able to calculate the value of a stock or calculate the value of business in both the scenarios, right? When we own it, right, and when we do not own it, right? And the answers are a bit different. When you own it, there's a good amount of study, right? When you own something, you value it more, so you want a bit higher price, right? And so let's talk about a scenario when there are three offers, right? It's you, me, and the market, right? And the business is producing now $3 million of profit, right? 1 million for each of us, right? And so the business is in the stock market, right? And now let's say so each of us own the business, right? So each of us will be getting $1 million of profit, right? Fair enough. What would you do if the business is selling for $1 million in the market? What do you do? All of you, I want an answer now. Given we are already able to calculate the value of the business, right? So I want to get an answer, right? What would you do? Would you buy it? Would you sell it? If the market is selling your business that you're partnered with 3 people, right? You, me, and someone and the market, right? If the market is selling for $1 million, would you buy it? Hold. Okay. Bibji saying hold. Okay. Bibji, you're getting $1 million. You're able to buy 33% ownership of it for such a low price. You are able to remember you're saying you want to buy it for 20 times, right? $20 million, right? You're getting the business for $1 million, right? So in this case, it would be yes, right?
Well, it'll be a third of that, right?
Yeah. No. So in this case, the business is getting $3 million. Sorry, it's getting $3 million of profit, not $1 million. So market gets $1 million. Makes sense?
Okay.
The 3 partners, each of them get $1 million, $1 million, $1 million. Are you getting it?
Yeah.
So in that case, would you buy it or not from the market?
If the business is selling, oh, I see. I thought you were saying selling the business. So then for the first one, yes. For the second one, no. I got them backwards.
Yeah. No, again, we're talking just you are the owner. You will not sell your part. Your 33% stake is never sold. Only we're talking about the market part, which is because your company went public. You're listed 30% of your shares on market, right? You're making $3 million of profit. So each of you get $1 million, right? Share, right? Is that correct? Because
Yeah, I see.
Right? So
Yeah.
would you be so if the market is selling for $3 million, you would be a buyer again, right? Is that correct?
Yeah.
Okay. What say at $10 million, right? Correct. But what if the market is selling for $100 million? The same company. Would you be a seller or a buyer?
Seller.
Exactly. So I hope all of you got the concept, right? At a high level, we all can figure out the value of a stock, right? We have a range. And what I wanted to pass from here is like if we think as private business owner, we should not think like a business owner. We should think like private business owners, right? And if we think like a private business owner, we can calculate the floor value of stock. So let's put it in another way, right? Let's say the business is selling at 5 times its profits. We all know that's the floor value of stock, right? So we should jump in to buy. Is that correct? That time we should not wait, right? We should not wait for more opportunities to come in, right? We should start trickling and putting our money. Is that correct? And so hopefully the next takeaway that I want to pass is like we all can think like a private business. We should all think like a private business owner. And now we all know how to calculate the floor value range for the business, right? So if the business or the stock is being sold at near the floor value range, I want you to buy it. I don't want you to wait because you know it's a good business. You already understand the unit economics of it, right? So you should go and buy it. How are we doing? I think so. I'm gonna skip this in the interest of time. But here are super investors who are making more than 10% in the market, right? And like if you had just bought this basket of sectors, the top 4 sectors, you would have made more than the index. And that's what I'm trying to target with my strategy. This is a wonderful plot that I made. So essentially, what happens is like the stock price of the stock. It's like a man with a dog analogy. So man is a business in this case who is always trending up because it's a wonderful business. Customers love it, and the dog here is the stock price which trends ups and downs based on what people think about it, right? And so when the dog trends down, we need to be net buyers, and when the stock goes up, we could be sellers, or we could stay the course of time. It depends on your strategy. But I hope everyone understands we should not focus on the dog. We should focus on the man, the business in this case. Okay. So does anyone want to share a summary today?
I need to learn more math.
Again, do not lose capital. I would say that's the number one thing that you should remember. You want to only invest in companies where you will not lose your money. That's the number one thing, right? Avoid companies in high debt. That's what I'll say. Right? There are scenarios where you need to look at how much profits they get. What is the leverage ratio? I think that's the most important thing to look at, right? Again, buy with the margin of safety. We all know there are opportunities always in the market, right? You should be like a bargain hunter that you're in your real life, right? You should always think like a business owner, right? And now with the superpower of calculating the value of the stock, right? You know, right? When the business hits its floor value, at least you can jump to it and buy it, right? Can we all say that? Yes? No?
Yep.
Wow. Thank you. So here's my philosophy. My philosophy is very simple. It's a 3-rooted philosophy. The number one element is I want to avoid business where I lose my capital. In the past, I've done options, investing in companies that turned out to be bad. So my goal is not to invest in bad companies, not to do options. I feel options is like, they're like slow poison. They'll kill you with time. You never know, right? It's a time-ticking bomb. You want to really buy quality companies that have stood the test of time, that have seen recessions, that have seen bad times, that have been able to prosper, that have done the right things for the customer. Customers love them, right? At the end of the day, that's what matters for a business, right? So you want to look for those quality companies, right? And the most important question I ask when I'm buying a stock, when buying a company is like, is this company going to stay for the next 10 years? If it's not going to stay for the next 10 years, I'm not going to even buy. Is the company growing? If the company is growing, then only I'm thinking of taking the next steps. Otherwise, it's a no for me, right? So again, price matters. As we all were able to calculate the floor value, make sure you have the floor value calculated for your business so that when the price comes to that point, you buy it, right? Anything at a high price is not so as we told, right? As we talked about, right? As investors, our job is to make money, right? We are not going to go for high price. We want to get the value at a much lower value, right? And like we go to doctors for a periodic health checkup, we need business is a dynamic entity. So we should be doing quarterly or annual evaluations of the business. So there are tools that I have built that will help you do that evaluations, or you can do those fact checks, right? Like the quarterly statements or the annual statement, there's the business publisher, right? You should use this as a mechanism to do periodic health check of your business, right? And then do nothing. And whatever time you got, please spend with your family. because that is the most important thing, right? If you can spend time with your family or loved ones, I think you're going to compound your wealth for a long time, my friends. And in all of this, the process matters, right? That's what I learned, right? It's all about the process. You can get lucky one time, you can get lucky two times. 2008 was there, I didn't have money. 2020 came, I had money, so I was able to jump in, right? Because I got the process. But I still lack certain principles. And that's why I built SECDAO.com, which we're going to talk about later, right? So I would say during your free time, learn about some companies, learn about companies that are making 50-week high, make 50-week low, understand what's happening with them, right? Understand their quality. If they're not quality, even ignore them. Don't even talk about it. Don't even spend time there. So I have a process by which within a minute I'm able to figure out should I invest or not, right? Study them. The more you study, the lateral knowledge that you build up is going to compound. That muscle is going to help you when those downturns are coming, right? And you can rotate your portfolio if you find a better opportunity, right? So that's my process. And again, a reminder, our goal is not to lose money. And remember, if you don't lose money, you can have good health. And that's what matters, right? You cannot buy your health back. I've seen a lot of my friends, when the stock drops, they just lose their health. They get unhappy. They show some signs. They get unhappy in the family. Fights happens. Bad things happen. Why to go to make a quick money, right? Instead, focus on, making like a 10 to 15% CGI and just stay the course of time, right? You have a lot of money, right? Yeah. This is why as I said, the process matters. And that's why I built SSADAO.com, which is where I do my process. And my goal is simple behind SSADAO.com. The idea is obviously to help other fellow investors, but it's for me. Like my goal is to give a stock, do those calculations, do the math as Bigji was talking about, and figure out should I spend my time on that or not, right? That's my goal behind SSADAO.com. It's something that I co-founded with me and my wife, and I'm really grateful for her to encourage me to build this out. So this is how it looks like on SSADAO.com. If you go to the front page, if you search for the stock, we'll show you three things, right? We'll show you whether the stock is undervalued or not. We'll show you what are the targets that you can expect in the next 3 to 5 years. We'll show you remember I was talking about the 50-week high and 50-week low. So if you look at Amazon, right, you'll see how how market has given you all opportunities to buy the stock every time, right? And you could have made 50% return every year, right? So what we do is we show a marriage of three things: balance sheet, cash flow statements, and income statement, right? We show all in one place so that you can make a very quick call: should you buy or not? Should I sell or not? Whatever, right? So again, I've done a lot of presentations with my community. They're all on YouTube. Happy to share with you. These are some of the reviews that I got from my community. Final thoughts: businesses, there'll be always uncertainties in the market. We are not gods. No one can predict when a downturn will come or when something go up. What I learned is you need to stay humble. You need to accept things. If it doesn't work out, doesn't work out. That's why I'm trying to buy a basket of good companies. I'm not trying to go all in one company. I'm trying to find a basket, right? And the only thing that I'll say to each one of you is do not invest because you want to make it tweetable. Invest only the money that you do not need for the next 5 years. Because if you don't need the money for the next 5 years, you will not be worried. And you'll see that every 5 years market doubles. And so you'll double your money. It's as simple as that. I came to US in 2012 and all the companies that I wanted to buy, right? They all have gone at least 5x. So I'm surprised why I didn't buy it. Maybe because I was scared, I didn't have process and whatnot, right? So remember, it's a work in progress. Keep learning, take care of health. That's the most important. If you have your health, you can make good money in the future. Trust me. Again, these are some financial disclosures with any stock financial position. I want to ensure that please do your due diligence, right? And whatever examples we told today or we talked about, right? It's just for education purposes, right? Whatever calculation I showed you, please just don't take it on the face. Every business has its own multiplier, so you need to figure that out. Okay? This is a wonderful quote from Warren Buffett. It says, in the long term, stock market is a simple device for transferring money from impatient to patient. And I want all of you to become patient, like you were when you were looking for those bargain hunting, right? When you're looking for those wonderful products that you want to buy on Black Friday. You ask your families to wait, right? I think we can do quiz if everyone's interested, but we'll skip it for now. Again, just to repeat, we want to be bank loan officers, we want to be bargain hunters, and we want to be we want to be a private business owner, right? I would say please remember these are the three things. If I take away, you want to remember from this session today, and your job is not to lose money. Always remember that, okay? I will always stress markets are not easy. It's not for the faint heart. You think it's easy, but it's not easy. Every day you're tested. The stock you brought, it keeps lowering prices, and you need to have the mental fortitude to wait for that to wait another day. Right? And it's very hard. Right? If it was easy, all of us would have made money. Right? But the only thing that I'll say is we need to just apply common sense. If we apply the common sense that we just saw, right, in terms of bargain hunting, in terms of being bank loan officers, in terms of being a private business owner, we'll be able to do well. We need to just act at the right time. We need to have the patience, the fortitude to do it, right? And the thing matters is how do you value the business? That's the most important thing. Feedback time. How do we do? Does anyone want to say something?
A lot of learnings.
I think it's interesting. A lot of this is more or less the opposite of what I've traditionally done.
Thank you. Thanks for sharing. I hope you learned something with you today.
No, very, very helpful. I mean, a lot of my investing I strike a few times, but I'm very nervous about being able to do it in the future. And this is all play stocks for me, but I don't often go off traditional analyst numbers. I am a news junkie. I'll go off public sentiment. So I'm trying to learn more about how to do the actual analysis versus just kind of like reading public sentiment and things like that.
Thank you. Thanks for sharing those words of wisdom. I appreciate you being so kind. Anyone else? We have 4 more slides. Something important, but yeah, go ahead. Anyone else want to say?
Very much like all the slides, you put a lot of time and thought into all of these.
So here are the next steps. Again, thank you for the wonderful feedback. We'll definitely again visit SSD.com. A lot of things are there. So does this sound like what you've been looking for?
Yeah, I think that this is a lot of definitely what I needed to expand my knowledge of finance.
Yeah. So I would recommend applying some of those principles, right? Do you see applying some of these principles then?
Yeah, definitely. I think
There's a wonderful
business owner.
Yeah. So there's a wonderful Chinese proverb says the best time to start was 20 years back, and the second best time is today.
There you go.
So I'm doing a cohort. It's on Maven. Again, I'm not a salesperson. Feel free to sign up if you wish to. Again, I just want a promise from all of you, right? Like going forward, you all become business speakers, right? You look at the business, right? Is that correct? Let's take a vote, okay? Is that correct?
Let's do it.
Something yes?
Yeah.
Thank you. So and that's what, and that's why it's a wonderful story. It comes to it's like, and then we all sleep well and rest of our lives, right? And spend quality time with our friends and family, right? Is that correct?
Yeah.
That's what we need, right? So humble request: if you like something, if you like what we did today, do pass the good luck to others. Spread the love of sleep and investing, right? And that's what I will be thankful for. And remember, giving is the best gift. That's what I had, my friends. And we can go over questions. Anything anyone else wants to chime in before we jump jump to questions? Okay, let me see if there are any questions on that question.
20
Sorry.
slides. Wow.
I have a lot of slides, so okay, we don't have any questions. So we're good. Anyone wants to ask any questions before we wrap up?
Do you have any good information on just documentation on how to get into analysis? Like I said, like my investing strategy has just been a little bit different than like a lot of people do, and it's partially just because I always have some form of news in the background. So looking, just learning more about the various.
So I didn't get your question. Like you're looking for analytical.
Yeah, like how to learn how to do business analysis documentation, I guess would be.
Yeah, so I am taking certain courses, so I'm happy to let me know what topics are interested in.
Oh yeah, how to read financial statements. That's a great one.
Yeah, so I been like most of my videos are public online on YouTube, so you can check them out. But yeah, I plan to take these courses depending upon how many people sign up. So if you think you're interested in any one of these, shoot me an email and we can talk further.
Sounds good. Yeah, definitely. The how to read financial statements is probably the big one. The others I'm usually pretty good at, I think. But yeah.
Perfect. Thank you. Thanks for your kindness.
Thank you very much for taking the time to do all this.
Take care. Have a wonderful day. Bye bye.
Thank you very much. Have a good rest of your day, bud.
Thanks, Sridhar. Bye.
Thank you, Pawanji. Thank you, everyone.